good economic news, and apparently thinking that in that economy we can absorb whatever potential trade disruptions could come our way, and they are already potentially coming our way with a number of countries, including Canada and the EU, and virtually every member of the EU, and Mexico now, threatening dramatic responses to our own tariffs on steel and aluminum products. So how do you play all of this? And you're in the middle of all of this. To Barron's associate editor, Jack Otter, on all of these developments. Jack, a lot of people like to step back and say, well, the volatility of the stock market notwithstanding, hey, interest rates are moving up just enough where I might look at something conservative and dull.
Yes, but as you know, I like to play Debbie Downer on your show.
Yes, you do, and you do it quite well.
I'm going right there by pointing out that what makes a difference, as good as it feels to see that real number, as you said, something to the left of the decimal point is great, but it's really the difference between what you're getting and inflation. So you're actually better off in a world where you're getting a 1% return with 1% inflation than a 3% return with 4% inflation, in which case you're losing money day after day. And we've been in this incredibly low inflationary world, and I know people will say they've seen certain prices go up, and that's real, that's true, but for the most part, overall, low inflation. And so yields have been low. Now, yes, we're seeing yields go up, but we're seeing lots of reasons inflation might be going up as well. And you just mentioned one of them, tariffs. I mean, right. If steel inputs are going up 40%, that's not just I-beams. The Journal today writes that Hershey Kiss wrappers are going up in price. So you could really feel that. So yes, take advantage of them, but also think about other ways to get income. We like MLPs right now, Master Limited Partnerships. They are the pipelines that carry oil and gas. They were unknown, then extremely popular, and of course they got ahead of themselves and really crashed pretty hard. And investors have still seemed a little wary of getting in. And so we see some pretty good value there, even as these companies have gotten a little more conservative. So you're looking at 6-7% yields.
Wow. We see a lot of these signs outside banks for CDs and all that. I was joking with you during the break. Do, in fact, now, for the first time, have a number in front of the decimal point. And there, it's your preference whether you want to go a little further out or a little closer up. But it's still not a eye-popping return, just no more than it used to be.
Yes, and remember that when rates go up, banks are very quick to charge you more,
right,
and not so fast to pay you more. So look at your brokerage statement. If you have money in cash in a brokerage, they're paying you nothing still. So you can go to, say, a short-duration bond fund or a floating rate fund and get a little bit extra there. With the CDs, I would still tend to stay in the shorter duration, the 1 year, 2 year, 3 year, rather than the 10-year. But one little trick you can do is, if the 10-year payout on the CD is a lot better, check the fine print, ask at the bank and say, if I were to cash this in early, how bad is the penalty? And if it's only 1 or 2 months, go for it. And then if rates go way up, take out the money, pay the penalty, and invest it at a higher rate.
I wonder why a lot of brokerage firms or investment banks don't raise their cash rate, because a lot of people see this, geez, I can get more just running to my bank to do this.
Because they don't have to.
They don't have to, is right. But
most
people, if they were to know that and see that this is ridiculous, they're gouging
exactly.
me. Now, you mentioned the tariff environment that could be inflationary, because then we got a host of goods that come into this country. We're already hearing from the Mexicans they're going to slap tariffs on a lot of steel products themselves, lamps and berries and grapes and apples, pork chops. Don't touch pork chops, by the way, but apparently they are. And Canada's looking at whiskey, orange juice, steel, aluminum, and on we go. This is going to get nasty, and this is going to get expensive. Now, does that filter into just higher inflationary numbers, period, or does it just depend?
I would say it depends, but there's one important thing that people tend to forget, and that is when you slap, say, 25% tariffs on foreign steel, U.S. steelmakers don't keep prices where they are. They raise them 24.9%.
Yeah.
And so everything goes up. And then, so if things get more expensive for our trading partners, then they start charging more, not necessarily in retaliation,
right,
but their inputs go up because steel prices around the world could go up. So yeah, it's a great way to spark inflation.
This is going outside the purview here, but are you surprised, Jack, that with the threat of a trade war that is indeed now escalated, certainly beyond China, to our friends and to them promising retaliatory efforts of their own, that's not concerning traders at all?
Yeah, and I think the reason is because the market really discounts the Donald Trump factor because he does change his stance frequently.
So they don't think it's going to happen, or?
I think that there's a certain amount that's priced in, right? There's but the rest, I think it's just a wait and see thing. Is this really going to happen? And the other times we've thought it's really going to happen, it isn't. It turned out to be a negotiating tactic. So I think
but
traders
people all suspect that it's a negotiating tactic, or that he won't deliver the goods on that. Invariably in these trade wars, someone miscalculates.
Yes, I think it's a very dangerous game to be playing. I don't recommend it.
Right.
But I do think that the market at this point is still kind of holding back to see where it all goes. And one example where he did pull back is on the ZTE thing.
Right.
And in that one, gee, it seemed like maybe a tougher stance would have been warranted. So if you're not going to be tough on ZTE, are you really going to go into a full-fledged trade war with the French and the Germans and the English? I think the market is dubious that that'll really happen.
Do you think there's a method to what he does? I mean, I don't mean this to be patronizing. I'm just wondering. No. A lot of people say, well, no, he's shrewd. He's the art of the deal, all that there's a strategy here. Or is it impulsive, which might have the same effect? But there isn't really any gaming going on here.
I've struggled with this, and I'm not inside Donald Trump's head. I don't have great sources there. I will say what I've said to other people is that at the moment I'm seeing a little more crazy and a little less Fox. But that can shift. I mean, we've seen movement with North Korea that we haven't seen before, so maybe the negotiating is working there. So I don't want to discount that possibility, but it does worry me when you see things like this morning tweeting in advance of the jobs number.
Yeah, that was interesting.
You know, Doug Cass said that on Wall Street, that's actually illegal. you don't do that.
Yeah, a lot of people said, by looking forward to the employment report, that it was telegraphing. He knew what it was, and it was a good report as it turned out an hour before it came out. But,
and the markets reflected that. I mean, the markets zoomed, and then, in fact, the U.S. dollar went up even. I mean, this was broadly accepted by the market as.
But Larry Kudlow was telling Stuart Varney, no, nothing. But you got to be beyond reproach there. You got to make sure there's no hints of that.
Can I make one more income point that I should have made, and that is, for all of our adult lifetimes, even yours, Neil, the bond market has been a pretty good place to be because the yields have been coming down to the point that they are painful, but that means the value of your bond actually goes up, which is a strange inverse relationship.
Excellent point.
We could be at the turning point now where that goes in the other direction. You mentioned 1969. I don't think it's a coincidence. The jobs number was that, or the unemployment was that low. And there was about 20 years of really bad bond returns because yields were going up. And that means that the bonds people were holding were going down in value. So we could be in a position where your bond portfolio does not act as a shock absorber to your stocks. In the past, or in our lifetime, when stocks have fallen, bonds have tended to go up.
Right.
It could be that when stocks fall, bonds will also fall. So people need to think about that possibility in their portfolio and really diversify. CDs, they'll be fine.
Right.
So some CDs, maybe some of these MLPs and floating rate funds that I talked about, but really diversify and don't expect that nice safe bond fund will always stay safe.
I'm such a nerd out to you that when people ask me, what do you remember most about 1969? I say a 3.8% unemployment rate. And everyone points out, oh, yeah, Neil Armstrong walked on the moon. All right, there was that little detail.